Hello and welcome to the American Compass podcast. My name is Oren. I'm the chief economist at American Compass, and today we are joined by Julius Krein, member of the American Compass board, editor of American Affairs, president of the New American Industrial Alliance, and one of the country's leading experts on and proponents of industrial policy. He wrote a really great piece for us for Commonplace last week on the idea of sovereign wealth funds, something the Trump administration has talked about, something he points out the Biden administration actually been talking about, and what could be a really important tool in promoting reindustrialization. It's also something that has really come into focus just over the past week as we've seen the administration move forward with taking an equity stake in Intel. What is the appropriate role for government in investing in the private sector? What kinds of investments make sense? And what's the policy framework under which that should happen are all, I think, incredibly important questions. And he does a great job walking us through the different kinds of sovereign wealth funds, the different ways it might make sense here, and what you would need to get the policy right. So I think a really good conversation can be very relevant to a lot of the policymaking debates coming up over the next 6 months or so. So stick around for that. But of course, first, let me tell you what else we have at Commonplace this week. Yours truly had what, if I do say so myself, is a very interesting piece on illegal immigration and the way it creates a sugar high for the economy. Obviously, if you let in millions of people, you will see more jobs, you will see higher total GDP. That doesn't mean American citizens are happy. And conversely, when you start to actually enforce immigration law, and as we've seen, very large numbers, more than 1 million, according to Pew, have already left, you are going to see reductions in jobs and slower GDP growth. And that is entirely normal and, in fact, something you should expect. So how to make sense of what is going on in the economy in the context of an unprecedented reversal of illegal immigration, I think, is really important to wrap our heads around. And hopefully the piece is helpful on that. We had a great piece from Brad Littlejohn on distinguishing different types of digital predators because there are different levels of threat, different necessary remedies when it comes to protecting kids online. And a really good piece also from Ganesh Sitarman and Asad Ramzanali on data centers and the economic consequences for them locally and the reasons they are really not something we should be subsidizing. So check out all that. Of course, we've got Understanding America back to you on Fridays now. Friday is obviously a better day for a roundup than a Monday, it turns out. So hopefully you are enjoying those, and hopefully you will enjoy this discussion with Julius Krein. And we are joined now, fresh off his Boffo Bloomberg profile, Mr. Julius Krein. How are you, sir?
I'm well. Thank you for having me.
I think this is your first time on the podcast. Is that right?
It is. Yeah. Long-time listener, first-time caller. I've never gotten to say that on a podcast before. So
well, there you go. We love working with you in all facets of what we do at American Compass. And I think this is an especially exciting time to be talking about, especially the intersection of industrial policy and finance. There's a lot going on with discussion about what might a sovereign wealth fund look like, what happens next on industrial policy, whether that's with chips, with ships, with rare earths, with whatever else might come next. You, in addition to being editor of American Affairs, are you president, chairman? What is your title at NIA?
My official title is president.
All right, president. That's every organization needs a president. NIA is the New American Industrial Alliance, and I think folks might be familiar with the Reindustrialize conference that you guys put together, but bringing together really for the first time as a coherent industry group with interests, both the manufacturers, tech companies, finance companies that are actually going to be the tip of the spear on any successful reindustrialization that might happen. So I guess we wanted to start with a great piece you wrote for us for Commonplace on the idea of a sovereign wealth fund, what it could look like that would be good, what it could look like that would be bad. I realized in something else I'd been writing on the topic, the first thing the editor did was highlight sovereign wealth fund and note you actually have to explain what that is to the typical reader. So let's start there. What do you think of as the typical sovereign wealth fund, and what could or should it mean in an American context?
Yes, the name sovereign wealth fund is a bit unusual in the American context because for the most part what these things are is a vehicle to sort of recycle foreign exchange surpluses for large exporting countries, usually natural resources exporters, that have all these, say, extra dollars that they, if they're a small country, they can't really recycle that into their own economy very easily. So they need this new fund to invest it, whether domestically or abroad, often abroad. And that obviously does not describe the situation in the United States. We are far from a major exporter. We are a chronic trade deficit country. We have $30 trillion of debt. And so a sovereign wealth fund, when people hear that, they're sort of confused. But I think what it has come to mean, or what it should mean in the American context, is really something more like a development bank. Now, it's interesting, I think, because people, there's a certain Trump aesthetic to the term sovereign wealth fund. He likes
It's
he
got
likes going
sovereign,
to the
it's
Gulf.
got wealth.
It's got sovereign, it's got wealth, exactly. But actually, it was the Biden administration that first started using the term sovereign wealth fund in the American context. Sort of toward the end of the administration, there was a real plan to try to launch one. They never got that off the ground. But I really think of it more in terms of a development bank. We obviously have a number of strategic, critical investments that need to be made that for various reasons are not incentivized or even disincentivized and penalized by the ordinary operation of private financial markets. And whatever you want to call it, sovereign wealth fund, development bank, some kind of public vehicle would be a great way to sort of bridge the gap that's required between normal market actors and the country's strategic investment needs. So it's not surprising that this concept has been around for several years now. Both in the Biden administration, there was also a proposal, and this has been publicly reported in the Washington Post, but there was a Vance-Coons bill when Vice President Vance was in the Senate on this kind of development bank concept. They called it the Industrial Finance Corporation. And then, of course, the Trump administration launched their executive order, or issued their executive order early in February. And now we're sort of at a point where the rubber, in one way or another, I think, is going to hit the road here in the next few months. And hopefully we'll end up with a new and very intelligently organized, structured, and governed vehicle to make these investments.
So I want to flesh out a few elements of that, because I think it is also important to understand kind of what the typical fund is, what wouldn't work here, because there are some folks who have proposed, and the EO even potentially contemplates what would be a more traditional sovereign wealth fund in a context where, as you said, it doesn't necessarily make sense or work in the U.S. So you're pointing about the quintessential example is typically a smaller, natural resource-rich country. Think a Gulf state. Norway is another quintessential example. Singapore, a little different, but plays a role as kind of a small exporting state. You basically have a situation where the country is producing and exporting so much that, let's say essentially hundreds of thousands of dollars of value per person who actually lives in the country, that you could exchange that for that much stuff coming back in and consume it all. But that would, in a sense, be literally hard to do. And more importantly, if you're a country that doesn't know that is going to be sustainable indefinitely, you want to actually take that and convert it instead into productive investment. And so you need some sort of entity then that is going to essentially say, great, we will trade all this oil we are pumping out of the ground now for actual stakes in productive assets that could benefit our nation in the long run. Does that capture what the typical fund is doing?
Yeah, I think that's accurate. I mean, you can also kind of, they're interesting cases each in themselves. So Norway, for example, I think, their probably focus has been their kind of non-economic focus with their fund is I think it's fair to say environmental, sustainability, whatever you want to call it. The Gulf states, there's a little bit more of domestic development attached to it, or, a kind of strategic foreign policy attached to it. And then Singapore is maybe the closest to using it as a mechanism for Singapore's own economic development, in addition to chasing returns overseas. Singapore, for example, used it to seed a bunch of venture capital funds at one point in its history. So yeah, each of these has kind of a non-economic purpose attached, or a purpose that's not simply involved in chasing short-term returns. And it's interesting to compare them across the different countries.
Right. And so in the US case, what's so different is that we don't have these large surpluses we need to deploy somehow. We, in fact, have massive deficits, whether you're talking about it, the trade context, in the federal budget context, and as a result, 30 plus trillion dollars in debt. If we had a bunch of extra capital lying around, presumably the first thing we would do is retire some of that debt and reduce those deficits. There are proposals out there to essentially lever ourselves up further. That is, literally borrow more money at the rate the federal government can borrow money and invest that, uh, for instance, to try to shore up Social Security and so forth. Do you find anything useful in those proposals? Do you write those off? Where, if at all, do you think that fits in?
I personally don't find those very compelling. I think in the short term, you can make the argument that, the stock market will return more than a U.S. Treasury. So therefore, if you take some of this, if you borrow at Treasury rates and invest it in the U.S. stock market, you will earn a return that, will be greater than your cost of capital and in theory, reduce the deficit. First of all, many countries do this with their sort of Social Security. Argentina being the one I know most of all. I wouldn't say that's had tremendous results for them. And the problem is you can kind of only do it one time. And then the other issue is you could argue that the main problem with the U.S. economy is that our asset values are already so detached from incomes or the quote unquote real economy. That's sort of further expanding that gap by putting more government resources into it and bidding up asset prices would in the long term maybe even make the situation worse. I think the main purpose this could serve is, and as I've written in the Compass piece and in more depth in the piece in the Techno-Industrial Playbook and in other writings, basically we have a problem where all of the strategic, capital-intensive manufacturing sectors, whatever you want to call them, they have returns, let's say somewhere between 5 and 12, 15% returns on equity. And that is, those are still positive returns. You're not destroying capital. It's not, you don't need a grant program, but they're below private sector hurdle rates, which are going to chase your software like returns and things like that. And you also have the problem that all those sectors are also subsidized by other countries' industrial policies, and in particular, our leading rival, China's industrial policies at an extreme level, further driving down returns, making them unattractive to U.S. investors. So you sort of have to bridge the gap between these strategic, capital-intensive sectors and where private sector hurdle rates are. And this is where a sovereign wealth fund could be most effective, in my opinion. And in unlocking and channeling more private capital into that space. And that would also, in doing so over the long term, help to reduce the trade deficit, build up more and more American industry, connect more and more American workers and citizens in general to income generation, high productivity sectors, which, the current setup, the so-called fissured economy, sort of separates them from, I think that would be the core focus of the sovereign wealth fund, both a national security element to it, as well as a broader macroeconomic focus to bridge these gaps and strengthen the long-term competitiveness of the U.S. economy, and also begin addressing these long-term trade and financial imbalances that we're dealing with.
Yeah, the distinction, I guess, is sort of between the financially engineered or creation of paper wealth and the actual improvement in real wealth as reflected in productive capacity. If we borrow money at one rate and use it to buy assets that we think are going to deliver returns at another rate, you may in fact increase the paper wealth attached to the government if you haven't actually done anything to expand the productive capacity of the economy, the opportunities for workers, the output that gets generated at the end of the day. You haven't actually improved anything. And so what I take it you're describing is, and to dive in on kind of the hurdle rate concept a little bit, there are essentially some places we would like to see relatively more actual investment happening in the real economy because it has a lot of benefits beyond what investors are otherwise chasing on their own. And so at the end of the day, the premise of this fund, and as you said, is it's a sovereign wealth fund, an industrial finance corporation, whatever you call it. It is in effect to subsidize certain types of investment so that those investments become attractive ones for the private sector to pursue.
That's correct. And I think another important feature of this model is, as you know, I have plenty of criticisms of kind of free market fundamentalists. But I think they have a general point that it's, in an ideal world, you don't have government bureaucrats picking which companies are receiving money and which ones aren't. With the sovereign wealth fund model, you can structure these things such that it's still private investors, private entrepreneurs who are making the decisions at the firm level, but you are sort of opening up sectors that otherwise the private sector really wouldn't touch because the returns in those sectors just aren't attractive, because they're capital intensive, because China's subsidizing them, whatever, which I think is another important feature of having a sovereign wealth fund rather than, too many direct individual government investments.
Right.
On an ad hoc basis.
So what are the key elements then in structuring this kind of thing well? Because, to your point, we have something like the CHIPS Act now, which is in some respects doing this. It is encouraging private capital investment in very large advanced chip fabs, but that is also a clear instance of policymakers deciding what kind of thing we want to build more of. One thing that appeals to me, I think, about more the sovereign wealth fund concept is, as we saw with the CHIPS Act, that was a sort of 5-year process to stand up that one tool. We're now maybe going through it again with ships, conveniently rhyming with chips. And if that's another 5 years, if every time we think of something we need, we spend 5 years putting it together, we're not going to get very far. In theory, this is a sort of more generic general purpose tool, but what are the key elements of its actual structure so that it can do a lot of things? It can rely on markets to determine what should happen, but it also doesn't just become sort of a slush fund for anything.
Yeah, I mean, one of the key advantages to it is that it's a fund. So you can appropriate money to it one time, and then it will make investments. It will earn returns on its investments. You don't have to have ongoing appropriations, new bills, things like that. The other part of it is, again, you can use the advantages of government leverage, government borrowing, to take a fairly small appropriation and turn it into a large amount of resources. And then beyond those purely financial things, setting up a governance structure that is both politically accountable. It would be created by Congress and would have to be essentially a bipartisan act of Congress, but which also, is kind of long-term and evergreen and can do trial and error, which is central to all industrial policy. And it's, one of the problems with chips is that it's very much a sort of stopgap measure. It was a kind of one-off thing. You are going to get, we have already gotten a lot of plants and investments out of it, but then it ends, and then what happens? And it also doesn't, it's fairly rigid. It's proved to be maybe less rigid than the statute might suggest, but it's still fairly, they're limited statutorily in what they can do. Whereas I think there's a lot of areas with a sovereign wealth fund that you could endow it with a lot of the necessary capabilities up front. For example, when you deal with things like critical minerals, one of the main challenges is price volatility. Some of that is just natural because it's in a liquid market. Some of it is not so natural. China basically controls this, and when they see too many Western companies, they crash the prices and things like that. So with a sovereign wealth fund, you could do various derivative instruments, other kinds of take or pay agreements, things like that, to mitigate this price volatility without requiring some new congressional authorization act, all this sort of thing for for each. So those are just kind of some of the basic advantages that I think this makes a lot more attractive than again having to do a one-off bill for every sector, which is not going to happen. You also just have chips is very unique in that it remains a very large capital oligarchic sort of sector. I mean, there's not very many companies that can do chip manufacturing. So the government can kind of interact and deal with them all. But if you get down to things like ball bearings and machine tools and many other inputs, HVAC for ships is another one I've been learning a lot about, which I never thought I would. But then you're dealing with hundreds of companies, dozens of middle market private equity firms. Even if you wanted to have kind of that kind of top down single sector bill approach, it would just be very difficult to execute. Whereas with a sovereign wealth fund, you can kind of do a loan guarantee program, do a kind of Wall Street style financial structure, and they can just come to you and fit in that much more easily.
Yeah. So the two elements that sort of make the fund structure so distinct, and to your point, it is a fund. One is upfront on the financing side, the point that this isn't something that now becomes a kind of budget line item that you're spending $20 billion a year on. This is something that you capitalize once. And so there would presumably have to be some sort of appropriation. You're going to need some essentially equity base to it. On top of that, presumably, would it have its own debt issuing authority? Would you sort of authorize it to issue, use treasuries essentially to fund it? Or what kind of leverage would you envision in the fund?
Well, now we're getting into a very interesting, wonky area. In my personal view, I would prefer that the fund sort of issue its own debt instruments, though they would obviously be U.S. government backed and effectively treasuries, but the money could sort of stay in the fund. Now that runs against this thing called the Federal Credit Reform Act of either 1990 or 1993, something like that, which sort of mandates that all this stuff has to be issued directly by the Treasury, and the funds flow to the Treasury and then back down. So that's something that Congress can decide. I don't think it makes a huge difference either way, but for a certain ease of operation at the fund, I think it makes sense to have it kind of have its own self-contained budget, and would also make it a little easier to track what it's doing and how it's performing and so on. Because what's interesting in it's true for all sovereign wealth funds that have not just a purely financial focus, but I think what you would see if the fund's returns are too low, sort of below zero, it's destroying capital, that would be a failure. But also if the fund's returns are too high, say 25% or above on a continued basis, that would probably be, it could be an indication that you're just seeding so many great industries that the private sector was ignoring. That's possible, but it might also mean that you're crowding people out. Because if the returns, if you're getting 30% returns, the private sector will do that. So I somewhat unusually in the American context, what you'd really love to see is like a 9% return on the sovereign wealth fund, which means it's making these, critical investments, but it's not destroying capital. It's not making bad investments.
Yeah. And so in terms of the scale of this thing, just so people have like an order of magnitude in mind, is this, in your mind, something you seed with $1 billion and levered up to 10, seed with 10 and levered up to 100? If we think of like chips itself as a $40 billion pool, what's the ideal scale you would want to see Congress targeting?
I think past ideas were kind of in the $50 billion appropriation range, levering up to $500 billion of total assets, total resources. I think the Trump administration has been actually considering numbers significantly larger than that. But it remains to be seen what their final decision will be and what they'll actually go to Congress and ask for.
And so you've got this fund then, it's got all of this money in it. It's interesting to think of the goal as being something that would deliver a positive return, because almost by definition then it has to be, at a minimum, it's not going to be grants, right? You're not going to generate a good return on a grant. And so that would be another way it's different than, for instance, what we've seen with the CHIPS Act. Presumably it would be either just equity investments that private markets aren't making because the return isn't as high, or like you said, it might be loans, loan guarantees. Um, that gets us into the sort of interesting question that's now come up around Intel and taking equity there. Um, does that work in your mind? Is it desirable to have essentially the government or a quasi-governmental entity actually taking equity stakes in big public companies?
Yeah. So, I mean, just taking a step back, we've published a few pieces on Intel and this problem specifically in American Affairs. And typically I give a disclaimer that, just because we publish it doesn't mean I agree with 100% of the article unless I write it. But in this case, I basically do agree with all of it. There were two pieces by Bill Bonvillian and Ken Flam kind of going through the recent history of Intel. And what you see there is this interesting situation. I mean, aside from decades of bad management and bad board oversight, which we don't have to go through, but right where we are now is Intel has its kind of foundry or manufacturing business that is of high strategic value to the United States. It's the only U.S. Company that can do anything in this area at any scale. And then, and that is, highly unattractive to private investors. And then Intel also has its own chip design business, which, interestingly enough, actually manufactures some of its designs with TSMC. But that is
should have been a red flag, maybe.
Bit of a red flag. More desirable to investors because it's like NVIDIA. That's what NVIDIA does. But it's really of very little or no strategic value to the United States because, after all, we have NVIDIA, we have a lot of other great chip designers. There's no reason for the U.S. government to promote another one. And so, yes, you have this odd mismatch where the strategic interest is not where the private market investors are interested. And so it makes sense. And there's a lot of other dynamics here where, chip designers, NVIDIA, Apple, Google, whatever, like they don't want to give business to Intel because they're concerned, or to Intel Foundry because they're concerned that then Intel chip design will steal their designs, and on and on. So there's this problem where the piece of Intel that is most strategically significant is the one that the private sector really doesn't want to fund. And, if it were left up to private investors, like they would probably get rid of the manufacturing business and spin off the design business and so on. So it makes sense in this context for the U.S. government to ensure the survival of Intel Foundry, ideally the upgrading, greater investment in it, improved capacity, skill of Intel Foundry. And there's probably no other way to do that than some form of direct investment of some kind. Now, what's interesting, I think, is when you get into equity versus lending versus grants and so on. From my understanding, and this is, secondhand, but it's really the private sector people in the administration that are pushing for the equity. And it's sort of counterintuitive, but if from people with a finance background, like equity is the most expensive form of capital, and it's more expensive for Intel investors for the government to take equity in Intel. Government is getting more of any future upside, and so it's actually a more strenuous form of capital injection than providing debt or something like that. So I think it's probably a step in the right direction. What the U.S. government has done in the past is we have these strategic sectors. We don't take a long-term view. We let them do share buybacks and cash returns without investing in their future. Then we have a crisis. We've seen this with Boeing, for example. And then there's a panic. And then it's, oh, no, well, we can't just, lose our national, we can't lose all capacity in this area. We have to do something. And then there's sort of a rushed bailout. But, the U.S. doesn't actually take any governance, golden shares, whatever it is. So I think this is actually a step in the right direction. And it's, ensuring not just more value for taxpayers, but, a stronger U.S. government involvement, formally or not, in the company's future. Where I think the Trump administration would benefit is having a little more coherent intellectual framework behind these things, as well as an actual policy framework, whether that be a sovereign wealth fund, something else. We can talk about this also in the MP materials context, which I wrote about. But at some point, having a coherent framework that people can understand what the parameters are, what you're doing, helps avoid the impressions of, arbitrariness and propping up zombies and all those sorts of problems that are real problems in industrial policy. Having it makes clear that there's a strategy to deal with them and there's accountability, and that these things are part of a larger portfolio that can be evaluated over time.
And so to your point about the sort of broader problems with industrial policy, the other one that gets, one of the other ones that gets raised that seems especially applicable to the context of operating a fund is, could the government actually operate a fund effectively? I mean, in some respects, taking something like the CHIPS Act, it's slow and cumbersome and tailored, but at the end of the day, policymakers basically decided, we care about chips, we want to give chip companies money. We know how to write a law that does that. If you actually had this fund with sort of its own $500 billion is a quite large fund. What does the governance structure for that look like? Who is running it, and what are their guidelines and then incentives going to be?
Yeah, well, I don't know if this is comforting or not, depending on your background, but I think most people point to a governance structure, something like the Fed, where you have staggered terms of a board that, the board is politically appointed, but once they're there, they have a certain degree of independence, because maybe the biggest red flag you want to avoid is, there's an election and the fund does a complete 180. It goes from doing, all green energy all the time to all coal all the time. That's not going to work. You need something that provides a degree of continuity, but also allows for obviously political accountability and changes over the medium term. And so the sort of Fed board model seems to work pretty well. This isn't a totally unheard of concept. The U.S. actually runs not one, but two development banks for foreign investments, DFC and Exim Bank. They do have their ideological critics, and they do have some practical problems with sort of how long it takes them to make investments and so on. But in general, they work pretty well. They're not huge partisan flashpoints. The domestic sovereign wealth fund might be a little bit larger of a challenge, maybe a larger asset base. But I think the same principles could work pretty well. And I think you would also see a pretty high degree of interest from people with private sector expertise and experience in wanting to join this fund, work at this fund. And we're also seeing, in the Pentagon, the Office of Strategic Capital, that is a fairly new thing, but similarly, and it's limited to loans and loan guarantees. But that has, the demand for it has been 10 times the amount that it received in its first round, and it's about to be expanded. And then the Pentagon has also run things like DARPA, In-Q-Tel, investment vehicles like that tend to be pretty highly regarded. So I'm not saying that there aren't challenges. I'm not saying that we don't have to be serious and get this right, and people need to pay attention to it and hold it accountable. But I think the model has been proven to work, reasonably well, not only in other countries, but even in the U.S.
And so I guess another interesting extension of the sort of Fed analogy is that presumably this board would have something akin to a dual mandate, where it is both, essentially it needs to be pursuing positive returns, but not necessarily maximizing returns. And it needs to be advancing some conception of sort of strategic priorities in terms of relevance to the health of the industrial base, or those are sort of the guidelines it would be given, and then it would have oversight of managers who have to execute on it.
Yeah, in the proposals that I have seen, Congress defines broadly what the strategic sectors and interests are, and also sort of big picture operational parameters, and then the actual board and officers make the determinations on which specific loans and other investments to make. And I think, as I said again, I think I think this structure is very important because, in my reading of the history of industrial policy, trial and error is sort of essential. And also just what works now is not necessarily going to work in 5 years. And the sectors will change and things like that. So having a model that allows for a degree of experimentation among the officers is crucial, but also longer term political accountability and certainly things like that also need to be there if this is going to work.
To the point about sort of the history of industrial policy, are there good analogs for this in the countries that have done this kind of industrial policy? In other words, does a China or a Japan or a Korea or even a Germany have this kind of instrument typically?
China does it a bit differently. They have what they call guidance funds, and this sector is quite large. It's by some estimates over $1 trillion are invested in Chinese guidance funds. It is as with a lot of things in China, it's sort of split between the provinces, or a lot of it is managed by the provinces themselves. The province can have their own guidance fund. There's also, because they have the Chinese Communist Party, it doesn't necessarily have to be an official state policy. It can be a party policy. But essentially, the party officials, provincial officials, other powers that be sort of announce that they're going to have a guidance fund focused. I mean, the biggest one that has arguably had the most mixed results is CHIPS, which is called the Big Fund. But they've also had, many more successful ones on things like electric vehicles, rare critical minerals, things like that. And so whether it's a province, a party official, whatever, they sort of announce, there's going to be a guidance fund. In this, they have private sector managers, but the government vehicles invest in them, and there's kind of an informal pressure for other banks and things like that, state-owned enterprises, to invest in them. So that's how they do it. Japan and Germany tend to operate more through their commercial banks, but they also have development banks specifically for industry. One of the interesting things about the recent trade deals with Japan and Korea are and I don't recall another example of this in the past, but these investment commitments, in addition to the regular trade provisions, Japan has committed to invest $550 billion in the U.S. or something like that. What that means, as far as I am aware now, it's still somewhat vaguely defined, is that for joint venture projects between Japanese and U.S. companies in the United States, these Japanese industrial development banks, will participate, will be available to finance that. So yes, they all these countries have them in one way or another, whether they call it a sovereign wealth fund, whether it's, driven more by the province or a kind of party level or something. But I'm not aware of a single, successful case study of industrialization that didn't have some form of investment component like this.
So what is the legislative prognosis then? Because there's an interesting case where, to your point, there's a Trump EO on this. There have been passed bipartisan legislative efforts. It's something that inherently seems appealing to a lot of folks on both sides of the aisle. Is there an existing legislative vehicle you would put your money on right now? Do you think there's something new that needs to emerge? What should folks be looking for, or what do you want to see?
On the sovereign wealth fund, in the sense of a new fund, we're sort of all waiting on the White House to decide where they want to go with it. They have the executive order. That executive order instructed the Treasury Department to kind of come up with a plan, which Treasury did, and they submitted that, I think, sometime around July 4th. And now it's up to the White House to decide what they want to do with that plan. If they decide they want to do it, they will have to go to Congress. I know there are some significant Republican supporters of this. I also know that a number of important Democrats have signaled that this is something they'd like to do on a bipartisan basis, if we want to go there. So I think it has real potential. But of course, starting anything new is one of the most difficult things to do legislatively. And the calendar is, we're going to be getting into NDAA stuff coming up, and it'll be busy. But I think it's definitely a real possibility. and all eyes are on the White House and what their decision will be. The other option, which we saw sort of not just floated, but really advanced significantly in the One Big Beautiful Bill, is the massive expansion of the Office of Strategic Capital in the Department of Defense. From their initial round, they had something like $984 million, and I already mentioned they got about $9.8 billion worth of applications. They have now been authorized to make commitments up to $200 billion, which, that's getting into, pretty big sovereign wealth fund territory. That's real money. They did not, realistically, they got 1.5 billion of actual money. Now, exactly how much you can lever that, it could be quite a bit because they changed the accounting rules a little bit. But it's not going to be $200 billion. And the other issue with it is, it's still limited to loans and loan guarantees, which again, I think is what most private actors want. That they don't want the government taking equity because that's more expensive to them. But it's still limiting. So I think you could, if it's possible to imagine the administration simply taking that existing vehicle, giving it a lot more money, maybe adding to its capabilities, and voila, you have a sovereign wealth fund there as well. So that's kind of the question we're all asking and we're all waiting for. And I should add, it is also possible to do both. Maybe that's asking too much, but they're not mutually exclusive.
All right. Well, we will keep an eye on all of that. You have written so much on this. The show notes will be rich with links for folks who want to read more all about it. But thank you for the great piece you wrote for Commonplace and for joining us on the podcast today.
Thank you very much.
And we'll be back again soon with another episode of the American Compass Podcast.